Let's bring in our next guest for more on the latest jobs numbers. Beata Manthe is the Citi Global Equity Strategist. Beata, thanks so much for joining us this morning. I want to get your read in on what we're seeing more largely here on the trend of economic data that's coming in.
So Citi economists have been highlighting for quite some time this underlying weakness in the labor market, so under the surface weakness. And this is starting to play out and be visible in the coming data, especially today. And what that means is there is a silver lining. And Citi economists' view is that we are indeed going to get the first cut out of the Fed this coming September.
Yeah, how many rate cuts are you expecting from the Fed this year?
So we are above consensus there. We have, Citi economists for the US have 3 cuts starting in September.
So your expectation is that inflation from here will continue to slow in large part because of continued slowing job growth?
Correct. So inflation is slowing down. The underlying weakness in the labor market is starting to show up. The Fed has a dual mandate and they are going to act on it.
With that in mind, as we're taking a look at the probability for a September cut, I mean, what as we're looking past almost this year, because now we've gotten from 6 or 7 cuts that we were talking about coming into this year down to 1, maybe 2. What does that set up for 2025?
That's a good question. Remains to be seen. We see continuation of cuts into the next year. But of course, as you mentioned, the market has been changing its mind a lot this year and has been quite data dependent. So remains to be seen. We see more cuts coming through in the next year as well.
Beata, you are a global equity strategist, so I would love to go a little bit more global with this conversation. We got to get your reaction to the UK election results. Prime Minister tendered his resignation this morning to King Charles. What can we expect from a majority Labour parliament?
So I'm most of all European equity strategist, so I can tell you much more in detail about what it means for equities. So in terms of the election, very widely anticipated outcome. What you need to know about it, that it's a more business-friendly Labour Party that we are having right now. And in terms of what it means for the equity markets, it's really going to play out, number 1, through rates, and number 2, through sterling. So in terms of growth and our view on FTSE 100 or MSCI UK, we are more bullish on other markets than this particular one. However, within the UK, our preferred election trade is FTSE 250 versus 100, or small and medium-sized stocks versus large-sized stocks. So they are more exposed to local economy. They are better positioned to benefit from the rate cuts that are coming through perhaps as soon as August from Bank of England. They are more exposed in a positive way to potential strength in the pound that we see in the short term. And also what is very important is that they have derated a lot versus large caps or FTSE 100 over the past 2 years. They are down. They underperformed 25% since the peak in 2001, underperformed year to date, and they are actually showing a superior EPS growth, double the one for FTSE 100 or the larger caps. So that's our preferred trade in the post-election world for the UK.
For those U.S. investors concerned about volatility ahead of the election, and they don't want to play Europe because Europe is growing very slowly, and it's unclear when the ECB may come across with another rate cut, are there emerging markets that U.S. investors could look to for potential alpha?
So in terms of our global allocation, we are right now overweight the US market, which we have recently upgraded to overweight immediately in the aftermath of this snap election announced in France, downgraded continental Europe to neutral. Emerging markets are already neutral, but within emerging markets, those countries that we like the most are Taiwan, Korea, and India.
Appreciate the insight. Beata Manthe, Citi Global Equity Strategist. Good to see you. Have a good weekend.
Likewise.